Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking about the gold and silver moves on Friday, that drop that we saw, also tie that into the US jobs data, and touching back on some gold ETFs that are starting to see some inflows. We're chatting with John Rubino. You can follow John on his Substack, which we will link to below. John, let's just start off with Friday's action. It was a rough day for gold and silver as both moved down quite aggressively. The stocks also followed on the way down. Couple news points that came out on Friday. One was that jobs report. One was also a report that China said they were not buying gold recently. I believe it was last month, whatever that time frame was, that clearly spooked a bit of the market in terms of gold, simply because the East has been such a huge driver behind the higher prices. John, what was your takeaway from Friday's action for gold and silver?
Hey, Corey. Hey, Shad. Yeah, that was brutal. I still have not looked at my trading accounts to see what happened in there, but I'm sure it's incredibly ugly. Was that the biggest one-day dollar move for gold and silver ever? I'm not sure what the actual record is, but this has got to be right up there. I don't remember $100 day for gold in the past, and so this was 80 something, right? And silver did $2 an ounce. That was a big move, and like you said, it had some catalysts with China announcing that they didn't buy any gold for a month after 18 straight months or something like that of buying pretty aggressively, and the jobs report, which was just a total pack of headline lies as usual, but a lot of really positive lies from the point of view of our government here, and that, assuming the headline number is real, which you shouldn't, but market participants do. That implies that the Fed can't cut interest rates anytime soon because the labor market is booming, yada, yada, so higher for longer. And that's not good for gold or silver either, because that implies positive real interest rates, which are normally not a good environment for precious metals. So anyhow, some data points, but I don't know if either of them are real. It's possible that China was just taking a month off with the idea that the announcement would knock the price back down so they could go back into buying again. And of course, the labor report in the US will be walked back in the next few months to a much less impressive number. And actually, I don't want to dig too far into the labor thing, but it is pretty funny the way they lie, because we have this big positive jobs number, but it turns out that all the jobs created were part-time jobs, and we actually lost full-time jobs, but nobody says anything about that in the official report headlines. And then it also turns out that all the new jobs created in like the last 6 months, basically net, have gone to people who weren't born in the US. And the number of people who are employed full-time in the US who are born here is actually shrinking. So not a sign of a healthy economy. But anyhow, the other thing which you mentioned was that gold is starting to flow back into ETFs, which is good news after a long stretch of gold flowing out of ETFs. So we've got a lot of mixed messaging out there, and gold and silver are back up a little bit today. So it looks like Friday is going to go down as one of those really extreme things that just happened, and then normality comes back. So I think that's the most likely thing. And then there was also the commitment of traders thing, which was set up for a big drop in gold and silver prices because the speculators had gotten very, very long and the commercials had gotten very short. Normally, that leads to a market correction in the favor of the commercials. So anyhow, lots of things. If it's just a one-day thing, it's no big deal. Then the bull market resumes. And without wanting to make a prediction about what's going to happen in the next 3 to 6 months, because that is impossible, it still feels like we're in a bull market for not just gold and silver, but commodities across the board. And we'll stay that way as long as the governments of the world are screwing up on the scale that they're screwing up. And it doesn't look like they're going to fix anything soon. So massive increases of debt, massive increases of currency creation, and a lot of that new money flowing into commodities. That's probably still the world we live in.
Well, John, just to that point, if you back up the clock just a month to the middle of May, that's exactly what the narrative was that people were moving into commodities as a way of diversifying out of the markets, and because of some of the government spending and, the inflationary, that it was a reflationary trade. Some people were actually more animated that the economy was improving, so we would need more commodities. But when you look at the moves in silver and copper, they're actually a lot more disturbing than the ones in gold. I mean, gold has rolled over a little bit, but it's still above 2,300 and it's mostly consolidating through time, and it's still got a really bullish looking chart. But when you look at silver and when you look at copper, they both finally broke out. Copper finally broke above 30, got up to 32 and some change. Copper broke out to new all-time highs up to 520, but now they've really rolled over hard. And does that change the narrative? Because it seems like just a few weeks later, now everybody's disappointed in silver and they're disappointed in copper and they're disappointed in commodities. Is all that growth and reflation over, or is this just a corrective move after a scorching move higher?
Well, two things. When volatile assets have a really nice run, they usually have pretty good correction after that because it creates so many people with profits to protect. And so if you start selling and that kind of snowballs and you get a correction. So that's pretty normal in a bull market, what we've just seen in terms of chart patterns and things like that. And then there's the higher for longer interest rate thing that flowed from the strong headline jobs report. And high interest rates are just flat out bad for commodities because if it slows the economy down, it decreases the demand for industrial commodities, and other things being equal, lowers the price. So that probably played a role too. But of course, as we talked about, that's probably fake. It's probably unlikely that high interest rates are going to stay with us long enough to be the main cause of a recession. There are other reasons for a recession in the next year or two, and that is an issue for commodities. Because debt is building up in a lot of different sectors, and you got the banking system with commercial real estate and everything, stuff we've talked about in the past. And they're all dangerously negative in their implications. So if we have a recession and an equities bear market and everything, well, in other words, if we have the normal thing you have after long run-ups like we've had lately, you probably get weakness in commodities. And so that's a real risk out there for the commodity sector. But at the same time, you've got massive increases of government debt and the necessity for central banks to monetize that debt to keep the bad debt that's out there from blowing up and giving us a 1930s style depression. So, lots going on. And I think the long-term story for commodities is still great. And the way to approach it is not to jump in with both feet in any way, shape, or form, but to dollar cost average your way in, and use lowball bids and write put options on stocks you want to get at lower prices and things like that. And then not really worry about these 3 to 6 month trends that are positive in some ways right now and negative in other ways right now. Just stack, just add to your positions in the things that have really good long-term futures. And don't feel like you have to be able to predict what's going to happen in the next 3 to 6 months, because smartest guys in the world in these spaces still can't make those predictions with any kind of accuracy, so we shouldn't be trying to.
John, one aspect of the commodities sector, again, that we've touched on here a couple of times is the East continuing to drive prices, and even the gold ETFs, the inflows that we finally saw after 1 year of consistent outflows, even as the gold price was doing well. That also can tie into a number of the other commodity sectors where we have seen the stocks broadly lag. Not so much in copper, but gold-wise, we're not seeing a ton of all-time highs out there like we are seeing in the copper majors. How are you viewing, when it drives down to the stocks, the Western appetite for it, which does seem to still be largely distracted?
Yeah, the way the stock trends tend to work in a sector is that the big names catch a bid first when the underlying commodity starts going up. And when that works out, the generalist investors come into the mid-tiers and the juniors and everything. And we're still kind of despite the correction of the last week or so, we're still kind of in the early part of that process. And it's nice to see gold in particular coming back into the ETFs, and which had to happen eventually. The ETFs weren't going to be completely emptied out and just have zero inventory. So at some point, the drain had to turn into a new addition trend, and that might be what's happening now. All this is pretty early. The whole China thing and the ETFs thing, we got 1 month worth of data, and that's not really useful yet for any kind of trend analysis. But Yeah, and speaking of copper, did you see that Sprott just brought out a copper physical ETF finally? Because that was the thing that was missing from the physical ETF space. You got silver, you've got gold, you've got platinum and palladium, and you've got uranium, all of which have performed really well in the last year or two. But you couldn't do that with copper because nobody had a copper ETF out there. But now, with Sprott coming out with theirs, that's something I would buy right away as soon as it's available to American investors, just because the whole physical ETF concept solves so many problems. It fixes the whole, oh, mining is really hard and there's geopolitical this and stuff like that. And you just buy something that buys you a bunch of that commodity, puts it in a vault somewhere, and you ride the commodity itself without having to figure out whether you're picking the best mining stock or not. So I think physical commodity ETFs have a place in people's portfolios, and it's nice to see a copper version of that coming along.
Yeah, John, it is interesting to see a physical copper ETF, which a lot of people thought would just be not practical because the amount of copper you'd have to store.
Yeah,
It's a lot.
That was always the question, what kind of a facility are they going to have if they're going to put, $1 billion worth of copper in it? That's like an airplane hangar or something.
Yeah, and we've seen the same thing happen, over the last couple of years with uranium, where they now have the Sprott Physical Uranium Trust, which again, nobody wants to take delivery of that. You don't want yellow cake showing up to the house. But when you think about how a lot of people listening play these sectors, something like copper or uranium, they're playing them through the smaller juniors. And in your own portfolio, you don't have to mention specific names, but are you still more leaning towards the more advanced producers and near-term producers of things like copper and uranium or silver, or are you getting down into the speculative explorers and developers at this stage?
Well, with copper and uranium, I'm still being lazy. I'm still buying the big names and the physical ETFs. And that's worked out really well so far because the concept, the underlying metal has done really well in both cases. But I think as time goes on, a lot of people are at least as lazy as I am when it comes to stuff like this. So there's not probably a ton of generalist money moving into the smaller players in those sectors yet. And that means they're probably still reasonably cheap. So it might be a time to start moving into the mid tiers and maybe even the explorers or something like that. Although that's a little bit beyond my area of expertise. So I'm nervous about that. But if trusted people start talking about good juniors in those spaces, I'm ready to start listening now. And with gold and silver, there's a lot of explorers and developers out there. And I own way too many of them, to be able to keep track of all of them. But I still think that's a sector where there's going to come a point when the generalist money makes their money in, they sell their Agnico Eagle and their Newmont, and they start looking around for what else might be a 3-bagger or a 5-bagger now. And they find all these names with pretty good stories. So there's going to be a serious inflow of generalist money into small precious metal related entities. And that's going to send them through the roof. So we want to be there when that happens. There's no way to time it perfectly or to know ahead of time what the timing is going to be. But let gold go to beyond 2,500, which it could easily do based on the last year of action, and let silver go up into the high 30s, low 40s, also very easy to do. And I think that's going to generate a lot of excitement in the smaller parts of the mining industry in gold and silver. And it's just going to be a blast to be there when and if that happens.
Yeah, when and if that happens, right? We've been waiting for that. Everyone thought breaking 2,100 would do it, then moving up to 2,400 would do it. And while there has been a little life in the juniors, man, nothing to the extent that we have seen in the past, even when other sectors are running. So that's the big question. When are the juniors going to start moving? And if they're even going to start moving, that's the big question. But, well, maybe they will. It sounds like you're starting to take some positions there, but man, oh man, we've been waiting for that throughout these breakouts. Hopefully that will come for all the investors.
We have, and all we had to do was buy NVIDIA 2 years ago. It would have been so much less work than trying to understand all these juniors, but the time will come. It's going to work out. And it is, like you said, it's just a timing question.
Well, I think it's even more than just a timing question. It's if it's going to happen. What's going to be that catalyst? And we can say time will come, but man, I know some of our listeners have gotten pretty tired of hearing, don't worry, it's coming, as they're seeing everything else break out. But well, higher metals prices do solve those problems, and it can bring in more investors. I think those ETF inflows are critical. If they can continue, that can really help push some more money into these underlying equities. John, thank you as always for your time. We'll chat with you again in another couple weeks. We'll also post a link to your Substack where everyone can follow along. John, have a great rest of your week.
Great. Thanks, guys. See ya.